All right, let's dive right in. Today we're looking at a very specific set of notes, the strategic analysis for EURUSD for February 16th, 2026.
Yeah.
And the mission here is to figure out why this market, which looks completely dead asleep, might actually be, a coiled spring.
It really does look dead, doesn't it? I mean, anyone pulling up the charts would think nothing is happening.
Exactly. You'd think your internet was broken.
But the notes, they call the sentiment neutral, but with this big asterisk. The phrase they use is coiling for breakout. So it's not sleeping, it's holding its breath.
Okay, coiling. Let's unpack that. Friday's close was right at 1.18689, which the analysis is calling the equilibrium point.
It's the dead center, the absolute center of gravity for the week. And if you look under the hood, I mean, the numbers are just screaming compression.
Right.
We're looking at an average true range, the ATR, of just 0.000722.
That is incredibly low. And the actual trading range itself was what, under 40 pips?
36.8 pips, to be exact. And the volume, it just fell off a cliff down to 277,627. So you combine a 36 pip range with that kind of volume exhaustion, and you've got a market that has just, run out of room to move sideways.
It has to pick a direction.
It has to. In market physics, I mean, this kind of quiet is almost always the prelude to a really violent expansion.
The classic calm before the storm. Okay, so the report lays out two battle plans. Let's start with the primary one, the bullish breakout. How do we know if it's a real move?
It's all about specific levels. We're not guessing. The entry zone is pretty strict. 1.1895 to 1.1905.
Okay.
The logic is simple. We have to see the price break the highs from the 12th and 13th. That's our proof that buyers have finally, chewed through all that supply.
So we're waiting for a 15-minute candle to close above 1.1895. That's the trigger.
That is the trigger. No jumping the gun. And once you're in, the protection is just as specific. Stop loss at 1.1855.
Which it's tucked right below Friday's low.
Exactly. If we go there, the whole breakout idea is busted.
Better to be wrong small. And what about the targets? Where are we aiming?
First stop is 1.1935. There's a pool of liquidity sitting there from the previous week's high. If we've got momentum, the next target is that big psychological number at 1.1980.
Okay, so that's the clean breakout. But markets are never that clean, are they? The notes also have a mean reversion play, a value play.
Right, this is for the patient trader. Because often, before market rallies, it'll take a quick dip, it'll try to shake people out.
To test the lows.
Exactly. We're watching for a test of that structural low at 1.1847. If price drops there and then immediately rejects it, you see that long wick forming.
Then you're buying the dip.
You're buying the value. The entry is a tight little zone, 1.1845 to 1.1850. The risk is even tighter. Stop at 1.1825.
And the target is just back to the middle.
Just to snap back to that equilibrium point we talked about, around 1.18 Nurio.
This leads perfectly into the judgment section of the report, which I found this part fascinating. It talks about a liquidity grab.
Yes, this is the head fake. The market needs fuel, right? So the analysis suggests we might see a fast, scary-looking drop below 1.1847, maybe right out of the gate.
Which sounds terrifying if you're already long.
It's designed to be terrifying. That's the whole point. It clears out all the weak hands. But if you see that snap down and then it's immediately bought back up,
that's the signal.
That is your high conviction signal to go long. The market just collected all the orders it needed to go higher.
But there is a huge warning label on this whole thing, isn't there? It's about leverage.
Oh yeah, this is the trap. Because the ATR is so low and the candles are tiny, traders think, oh, it's safe, I can use more size.
And then the spring snaps.
Yeah. When this thing expands, it's not going to be a gentle move. It will be violent. And if you're over-leveraged, you'll get wiped out before you even know which way it's going.
So the euro looks boring, but it's a very dangerous kind of boring right now.
The potential energy is it's through the roof. Watch the levels, wait for the signal, and whatever you do, don't get baited by that first move.
We'll leave it there. Keep your eyes on the charts.
Until next time.
And here's a final thought to take with you. If the market is essentially designed to hunt liquidity before moving in the intended direction, how often is your stop loss actually just providing the fuel for the very move you predicted?